Welcome to the deep dive. This is where we take all that source material, articles, research, our own analysis, and really boil it down to the crucial insights.
Yeah, give you that shortcut to being properly informed.
Exactly. With hopefully some surprising bits and maybe even a little humor. Today, we are plunging into Alphabet Inc., ticker GOG, the giant behind Google. We've got this really comprehensive fundamental analysis report. It's dated July 3, 2025. It unpacks pretty much everything: core business, strengths, leadership, the financials, market mood, and crucially, the big risks.
Right.
And here's the paradox, the really fascinating thing we want to explore today. How can a company that's so dominant, it's cash machine funds, AI breakthroughs, moonshots, how can it also face what some might call an existential threat?
And from the very source of its power, too.
Precisely.
Yeah.
We'll even look at its price, $180.55 as of July 3rd, and stack that up against what two pretty detailed models suggest its actual intrinsic value might be. Somewhere between, $142 and $168.
Yeah, quite a range and quite a difference in the market price, that tension, between the market's view and maybe the underlying business value.
Yeah.
That's definitely something we'll circle back to. It's key.
Absolutely. Okay, let's get started. Part 1, the foundation. We'll kick things off with Chapter 1, business analysis. The digital colossus at an AI crossroads. So our sources say Alphabet structure. It's kind of unique, maybe a bit like Warren Buffett's Berkshire Hathaway. It lets the mature, profitable core fund these riskier high-growth ventures.
What's really interesting there is how that big 2015 restructuring, it created more independence, more accountability across all those different companies under the Alphabet umbrella. The scale is just wow. Fiscal year 2024, total revenues hit $350 billion. That's up a solid 14% year over year. Think about adding the GDP of a small country in 1 year's growth.
It's staggering. And the heart of it all, the foundation, is Google services. That's the profit engine, right? Pulled in $304.9 billion in 2024. And the lifeblood, no surprise, is advertising. About 75% of total revenue comes from ads, search, YouTube, Gmail, Maps, plus that huge network of other websites using their ad tech.
But it's not just ads anymore, which is important. There's this rapidly growing stream from subscriptions, platforms, devices, YouTube TV, YouTube Music, Google One. They now have over 270 million paid subscribers combined. Plus, you've got Play Store sales and hardware like Pixel phones, Nest devices. It's becoming a really significant piece.
Then there's Google Cloud. This is clearly where they see a lot of future growth. $43.2 billion in revenue in 2024. That's massive 31% year-over-year growth.
Yeah, growth.
And this segment, providing GCP and Google Workspace, it just crossed this critical line. It's now actually contributing positively to operating income. That feels like a big moment, right? It shows it's maturing.
Absolutely pivotal. And we can't forget other bets. This is where that famous moonshot philosophy really lives. Financially, it's small, just $1.6 billion in revenue in 2024, and yet it loses a lot of money operationally. But strategically, hugely important. Ventures like Waymo, doing autonomous driving. Verily in health tech. Yeah. These are the long-term, high-risk, maybe high-reward bets that the core business is funding.
And geographically, still heavily U.S.-based.
Yeah, just under half the revenue, 49%, comes from the U.S.
So at its core, Alphabet's value proposition. It sounds simple, right? Organize the world's information and make it universally accessible and useful. For you, the consumer, that means amazing free services all integrated. For advertisers, incredible reach. And for businesses, these scalable AI-powered tools.
And it's not just a mission statement. The scale is real. Over $2.1 trillion market cap, 185,000 employees. Google's search dominance is almost total, like 89.5% globally. And mobile search is even higher, 93.7% as of June 2025.
Wow.
In cloud, Google Cloud is a strong number 3 with 12% global share.
Yeah, behind AWS and Azure. But here's the key thing. It's outpacing them in growth.
Okay, that's a good
And
one.
digital ads, a true titan. Over 42% of U.S. digital ad revenue. That's more than double Meta.
Now, looking at the industry, Alphabet sits right at the intersection of these huge trends.
Yeah.
Digital advertising keeps growing, like 9% CAGR, with AI making it smarter. Cloud computing is exploding, forecast to top $1 trillion by 2028.
$1 trillion.
Yeah. And then, of course, the AI era. Google's AI-first strategy, Gemini AI overviews. They're right in the thick of it.
But even with all that power, the competition is intense everywhere, isn't it?
Oh, absolutely. Search and ads.
Yeah.
You've got Microsoft with Bing AI, Meta, Amazon becoming a huge ad player, especially for products, even TikTok.
Right.
Cloud. Fierce battle with AWS and Microsoft Azure,
Yeah.
hardware and OS. Always Apple. Video streaming. YouTube's up against Netflix, Amazon Prime Video. It's competitive across the board.
Which leads to this big question. What's the single biggest external threat?
Our source points squarely at the regulatory environment.
Yeah.
It's described as a perfect storm. Major antitrust lawsuits in the U.S. DOJ, 50 states and the EU, remember those billions in fines? Plus this whole tangled web of new rules around data privacy, AI, like the EU's Digital Markets Act, the AI Act, new state laws too, California in Jan 26, Colorado Feb 26, demanding AI transparency.
It's coming from all sides.
Yeah, and even geopolitical leverage. Think China using retaliatory antitrust investigations. It just adds another layer of pressure.
So if someone wanted to compete, start a new search engine tomorrow,
Yeah.
what are the barriers?
Colossal is the word. First, capital. Alphabet's planning $75 billion in CapEx for 2025 alone, mostly for AI infrastructure. Who can match that?
Almost nobody.
Then technology and data. They've got 2 decades of data fueling this virtuous cycle for AI. And finally, ecosystem lock-in. Once you're using Gmail, Drive, Chrome, Photos, the cost and hassle of switching are really high for you.
Which brings us to their competitive advantage, their economic moat. This is where it gets really interesting.
It really is. Brand strength. First off, Google is literally a verb that builds huge user trust.
Right.
Then, cost advantages, economies of scale. Their massive global infrastructure means adding one more user to Gmail costs basically nothing.
Right.
And that R&D spent, $39.5 billion back in 2022. Just incredible scale.
And those network effects we talked about?
Classic example.
Mm-hmm.
Search. More users attract advertisers. Ad revenue improves search, which attracts more users. Boom. Android and Google Play work similarly. That ecosystem lock-in keeps you there.
Right.
Plus, they're unique assets. All that proprietary data, the fuel for AI world-class talent, that R&D culture, and undeniable AI leadership, right down to their custom hardware like TPUs.
So if we tie this all together, it comes back to that paradox, doesn't it?
Exactly. Google Services is this incredibly profitable cash cow, $121 billion operating income in 2024. It funds the high-growth Google Cloud, now just turning profitable, and those speculative other bets.
Right.
But the same integrated data-heavy ecosystem, their greatest strength is also their Achilles heel. It's the direct target for regulators worldwide focusing on antitrust and privacy. The strength is the vulnerability.
That tension is just unavoidable. Okay, let's shift gears. Chapter 2. Management evaluation. Stewardship in an era of scrutiny. Who's leading this giant?
Sundar Pichai, CEO since 2019. Been with Google since way back in 2004, led big projects like Chrome, Android. Sources describe his style as calm, thoughtful, strategic, very engineering-driven.
And his big strategic move has been...
The AI-first pivot, definitely. He's overseen these huge investments in foundational AI like Gemini, pushing its integration everywhere. It was a direct, necessary response to rivals like OpenAI and Microsoft. Shows they can adapt.
But how do they handle crises? Because big companies always have them.
Right. Well, take the Gemini AI controversy early in 2025. Remember the biased results?
Yeah, that was messy.
Pichai publicly called it unacceptable, admitted we got it wrong, promised changes. So public accountability, yes, but it also highlighted some execution stumbles in a really critical area.
And what about internal issues like the employee walkouts?
Back in 2018, yeah. Almost 20,000 employees protesting sexual harassment.
Yeah.
Pichai supported the protesters, acknowledged the anger, and critically, it led to them ending forced arbitration for harassment claims. A major policy change.
So is there a pattern in how they handle these things?
It seems Pichai's leadership style in crises is maybe more peacetime, often reactive, acting after significant pressure builds, whether public or internal, but the actions eventually tend to be constructive.
So maybe a risk of some turbulence before things get fixed.
Potentially, yeah. A risk of brand damage before the solution lands. And transparency. Well, broad strategy is clear, but on sensitive stuff like internal issues or algorithm tweaks, still pretty opaque. Though that 2015 Alphabet restructure did improve financial transparency for investors, that was a plus.
And the old motto, don't be evil.
Severely tested, you could say. Antitrust suits, privacy scandals, employee issues. It's taken some hits.
Okay, let's talk capital allocation, key for value investors. How do they spend their money?
Primarily, reinvestment. That huge $75 billion CapEx guide for 2025, mostly AI infrastructure. And they do strategic bolt-on acquisitions, like buying Wiz, a cloud security firm, to boost Google Cloud. Smart moves to strengthen the core.
And returning cash to shareholders, that's newer for them, right?
Relatively new, yeah, but they've really ramped it up. They bought back a massive $62 billion of stock in 2024.
Wow.
And then authorized another $70 billion in April 2025. That's a strong signal of confidence in future cash flow.
And the dividend, that was a big deal.
Huge landmark event. Paid their first ever dividend in 2024. Then in Q1 2025, increased it 5% to 21 cents per share. Look, the yield is modest, 0.47% forward yield, but the signal is powerful. Maturity, confidence, commitment to returning cash to you.
And how efficiently are they using all that capital? ROIC?
Return on invested capital, stellar. It's climbed impressively from around 13% in 2020 to nearly 26% in 2024, and it's hovering around 30% now.
And compared to others?
Dramatically outpaces the industry average, which is like 1.3%. Right? So highly efficient capital deployment. They're getting great returns on their investments.
All right, let's dive into the numbers themselves. Chapter 3, Financial Analysis, the engine room of a trillion-dollar enterprise. Just show us the power, right? Our market cap, as we said, $2.19 trillion as of early July 25.
Massive. And revenue growth trends over 5 years. Pretty impressive, even off that huge base. There was a big 41% jump in 2021 post-COVID.
Right, the rebound.
Then it moderated, high single digits in 22, 23. Things were uncertain globally. But it re-accelerated to 14% growth in 2024, search and cloud driving that. So revenue went from $182 billion in 2020 to $350 billion in 2024. Just huge expansion.
And profitability, margins.
Testament to that high-margin ad business. Gross profit margin, consistently high, 58.2%, TTM Q1 2025. Nearly 60 cents of every dollar left after direct costs. And operating profit margin expanded really nicely. 27% in 2023, up to 32% in 2024, hitting 34.3% TTM Q1 2025. That's partly cost discipline, but also Google Cloud finally adding to profits, not just taking investment. Net profit margin also improved 28.6% in 2024.
And free cash flow, the actual cash they generate.
Prodigious generator.
Yeah.
Went from $42.8 billion in 2020 up to $72.8 billion in 24. But as we said, CapEx jumped. $52.5 billion in 24, guided for $75 billion in 25.
That AI investment.
Exactly. It's a strategic choice.
Yeah.
Sacrifice some near-term free cash flow today for what they believe will be long-term AI dominance tomorrow.
Financially stable overall, though?
Oh, like a fortress. Earnings consistency is remarkable. Steady net income growth. Just that small dip in 22 with the wider economy. Debt to equity, super conservative, 0.38 as of Q1 25. They just don't like leverage much. Current ratio, 1.77 in Q1 25. Plenty of liquid assets to cover short-term debts. Robust liquidity.
And the dividend stability. It's new, but
Exceptionally safe. The payout ratio is tiny, just 8.9%. Loads of room for future increases if they choose.
Okay, now the big one, valuation analysis. How do we value this thing? Let's start with relative valuation, PE ratio.
Right. As of July 3, 2025, Alphabet's PE is 19.93.
And how does that compare?
Interestingly, it's well below its own history. The 5-year average PE is 25, the 10-year is 28. So compared to itself, it looks kind of inexpensive.
And versus peers.
That's where it gets really fascinating. Alphabet's 19.93 is way lower than Microsoft at nearly 39. Apple over 30, Amazon over 35. Yet remember that ROIC? Around 30%, right on par with Microsoft. So the lower valuation isn't obviously because they manage capital poorly.
Interesting. But relative valuation is just one piece, right?
Yeah.
What about intrinsic value, DCF?
Exactly. Value investors often prefer intrinsic value, often using a discounted cash flow model. You project future free cash flows, discount them back to today's value. Highly dependent on your assumptions, of course.
And our sources ran models?
Yep. 2 independent DCF models referenced. They came up with an estimated intrinsic value range of $142 to $168 per share.
Okay, $142 to $168. What were the key assumptions driving that range?
Mostly the discount rate, the WACC. The lower value, $142, used a 9.0% discount rate, reflecting maybe higher perceived risk. The higher value, $168, used 7.7%, reflecting lower perceived risk. Perpetual growth, like way out in the future, was around 3% in both.
So here's that disconnect again. Relative valuation says maybe undervalued. DCF models say maybe fully valued or even overvalued at the current price of $180.55.
Precisely. It's a fascinating contradiction.
Why the difference? What explains it?
Well, the market's PE might be looking more backward at past earnings. DCF is explicitly forward-looking. Maybe those DCF models are baking in higher risks or more conservative growth assumptions because of AI competition regulation. So an investor buying today at $180, you're essentially betting that the future will be better than those DCF models assume. A bullish bet on AI and cloud paying off big time, and maybe those models are too conservative.
Okay, let's move into part 2, market control, risk, and conclusion. Starting with chapter 4, market sentiment, gauging the Wall Street narrative. What's the mood on Wall Street towards Alphabet right now?
Overwhelmingly positive, actually. Analyst consensus is a strong buy. Like 89% rate it strong buy or buy.
Wow, okay. Price targets?
Median target is $195.50. You've got Goldman Sachs way up at $220, Bank of America at $200, Citigroup $200. Pretty bullish.
What's driving that bull case for them?
They're excited about Google Cloud growth accelerating, search staying strong, new AI features like AI overviews adding value, and better advertiser ROI.
And the bears, or the more cautious one?
They point to maybe slowing growth overall, potential ad budget cuts if the economy weakens, and those regulatory headwinds just won't go away.
How has recent news played into this, like earnings, the dividend?
Generally, the media tone leaned positive after strong Q1 earnings. That dividend hike, the huge buyback authorization, definitely positive vibes.
And why?
But it's always tempered by the ongoing antitrust fights and the risks around AI development, like that Gemini issue. The clouds haven't totally cleared.
What about market indicators? Short interest.
Remarkably low, just 0.65% of the public float. Basically, hardly anyone is betting heavily against the stock. Suggests the market thinks the big risks are manageable, or at least low probability.
And technically, moving averages.
Stock's trading comfortably above both its 50-day $173.33 and 200-day $172.61 moving averages. Both are generally seen as strong, bullish technical signals.
So, the disconnect again. Market sentiment, super bullish. Technicals, bullish. Analyst targets, high. Yet our intrinsic valuation suggests maybe fully valued.
Exactly. It implies the market is pricing in a very optimistic future, perhaps significantly more optimistic than those DCF models allow for.
Let's talk about who actually controls this company. Chapter 5, ownership structure. Who controls the Alphabet? This is pretty unique for Alphabet, isn't it?
It really is. Okay, top institutional owners are who you'd expect. Vanguard has 8
Held only by insiders.
exclusively, and each Class B share gets 10 votes.
10 votes, so the founders.
Co-founders Larry Page and Sergey Brin, through their Class B shares, they collectively control 51.7% of the total voting power, even though their economic stake is smaller now.
Over half the votes. Wow.
It's a massive concentration of power, and it's a real double-edged sword, right?
How so?
On one hand, it allows for long-term vision. Management is insulated from short-term market pressure. They can fund those crazy other bets without Wall Street freaking out every quarter.
Okay, that makes sense.
But on the other hand, significant corporate governance risk. Public shareholders like you have virtually zero power to influence the company's direction if the founders disagree. An investment in Alphabet is basically an investment in the judgment and vision of Page and Brin. You have to trust them.
All right, let's pull together the risks and opportunities. Chapter 6, risk assessment. A 360-degree view of headwinds. Maybe a SWOT analysis helps summarize. Strengths first.
Okay, strengths.
Yeah.
Dominant in search and Android.
Yeah.
Powerful network effects. Super strong brand. That fortress balance sheet. Huge FCF. AI leadership. High ROIC. Lots of strengths.
Weaknesses.
Over-reliance on cyclical digital ads, other bets, burning cash, that pattern of reactive crisis management we discussed, risk of brand damage from AI slip-ups like Gemini, and that dual-class share structure, limiting accountability.
Opportunities.
Lots here, too. Monetizing AI further in, search, ads, new products, continued growth, and importantly, margin expansion in Google Cloud. Growing subscription revenues, maybe Waymo finally becomes a real business someday, and the dividend and buybacks attracting value investors.
And finally, the threats. What keeps management up at night?
This is crucial. Intense global regulatory scrutiny, highlighted as the #1 threat. Major antitrust cases, new privacy, and AI rules.
Yeah.
It could fundamentally change how they operate.
Right, that perfect storm.
Exactly. Then, intensifying competition. Microsoft OpenAI in A-Search, Amazon everywhere, Apple. It's fierce. Macroeconomic headwinds, a recession would hit ad spending hard. Geopolitical tensions, U.S.-China trade war impacts hardware. Potential for foreign governments to retaliate against Google.
And the big one, technological disruption.
Always lurking. The risk of some new tech, maybe a better AI, maybe decentralized search, just eroding that core search mode. It's the existential threat for any dominant tech company.
So if you put it all together, the overall risk profile.
It feels asymmetric. The biggest downside risks, like a catastrophic regulatory outcome or search getting totally disrupted, seem existential, but maybe low probability. At least the market thinks so, given the low short interest. The upside opportunities, AI monetization, cloud growth, feel more incremental but potentially very large over time.
Okay, let's bring it all home. Chapter 7, conclusion. Let's synthesize. The bull case for Alphabet. You've got this incredibly strong economic moat, network effects, data, AI leadership. It's a financial powerhouse, low debt, massive cash flow, high returns, growing cloud engine. They're leading the AI charge and finally returning serious cash to shareholders. Plus, relative valuation looks pretty attractive.
It's a compelling bull case. But the bear case, despite all that, the regulatory overhang is huge. It's an ongoing, potentially business-altering threat. Competition is heating up everywhere, especially with generative AI changing the game. There's still that risk tied to digital ad spending cycles. Managing those colossal AI investments carries execution risk, margin risk. And that corporate governance issue with the share structure means less accountability to you, the public shareholder.
And reminding everyone of the valuation summary, our intrinsic value estimate based on those two DCF models landed in the range of $142 to $168 per share.
So as of July 3, 2025, with the Class C GOOG share price at $180.55, it is trading above that estimated intrinsic value range, meaning the market seems to be pricing in a very rosy future. From a strict DCF standpoint, you could argue it looks fully valued, maybe even a bit overvalued. But again, that contrasts with the attractive relative valuation.
So the final decision for an investor.
At this price, it really feels like an implicit bet. First, you're betting Alphabet navigates all these huge regulatory and competitive challenges without major damage. Second, you're betting those massive AI and cloud investments will pay off even more handsomely than those DCF models projected.
It comes down to confidence in management.
Confidence in their ability to execute on that future and defend the current empire. That's the crux of it, I think.
You know, this whole deep dive into Alphabet really throws that core tension into sharp relief, doesn't it? It's something so many tech giants face now. How do you balance having all this market power with regulators breathing down your neck? What happens when your biggest strength becomes your biggest target? It's a really fascinating dynamic to watch unfold.
It certainly is.
Well, thank you for joining us for this deep dive into Alphabet. Hey, remember, you can like and subscribe to the Stock Analytics AI YouTube channel. Members, for just $4.99 a month, get priority deep dives on tickers. And we're ambitious over the next few months. We're aiming to cover all the S&P 500 stocks, and members get that exclusive priority access.
That's a lot of deep dives.
It is. And if you just want a one-off deep dive on a stock you're interested in, just drop us a super thanks on YouTube.
And just the usual reminder, this analysis was generated by an AI system. It's purely for educational purposes, okay? It should absolutely not be considered financial advice. Please do your own thorough research or talk to a qualified financial advisor before making any investment decisions.